welcome to Let's Talk Tax, the show for growth-minded CPAs and real estate pros in tax. I'm Justin Gephart. On today's episode, we will discuss the latest on bonus depreciation. We will learn a little bit about the fundamentals of bonus depreciation, how and why it works, tax benefits, and who qualifies. Joining us today on Let's Talk Tax is Dave McGuire. As many of you know, Dave is a co-founder and shareholder at McGuire Sponsel and specializes in all things tax law and depreciation. Welcome, Dave.
Thank you.
So today, America's favorite pastime, depreciation. I know we fielded a lot of calls and questions over the past few weeks and months about the changes and what we see in the future for it. Can you give us just a little background on the things we've been discussing?
Yeah. So if we look at bonus depreciation, it's not a new concept, but it's not always been around. Bonus depreciation started right after the 9/11 attacks from 2001. So it was starting really in 2002. And it bounced around between 30%, 50%, up to 100% at some points, and really started leveraging out until the Tax Cuts and Jobs Act of 2017. Now, the Tax Cuts and Jobs Act, as you remember, made it 100%, but then it was slated to start leveraging down in 2023. 80% in 2023, 60% in 2024, and so on. Now, there's been a lot of legislation to extend that 100% bonus depreciation. Congress likes it because it typically doesn't have a big effect on the 5-year budgetary window for Congress, and businesses like it because it does allow them to accelerate writing off assets quickly. So we've seen this kind of bouncing around over the last few years. Whether it actually gets extended, we don't know yet, but it's important for CPAs and real estate professionals to understand where these things are.
You know, what's funny is you look back on that history of it. It was put in place to help spur economic growth and activity. And now it's just been, it's more day in, day out tax law, and people are expected to be around.
Well, that's part of tax law in general.
Yeah.
It's very hard to take away something that people have gotten used to. And we can look at that for many parts of the tax code. I mean, we deal with it on 179D, which obviously we're not talking about on this podcast, but we deal with it on a lot of different areas of tax law. Is once something's in tax law, it's very hard to take away. So even without these current bills that are slated to up bonus depreciation back to 100%, the odds of it actually getting to zero and going away completely are slim to none. At some point, someone will bring it back in, whether it's 100%, 50%, or somewhere in between. We don't know yet, but I don't foresee in the foreseeable future that bonus depreciation completely goes away.
So as we talk bonus, what's eligible? Is it, I go out and buy a building. Can I bonus that property?
It depends on the type of building. Bonus eligibility is pretty far encompassing. Now, it doesn't include the buildings that you mentioned, but it does include a lot of other assets. So statutorily, what it says is any asset with a life of 20 years or less. So that's typically, it's not the building itself, but if you come in this room, it's the desk, it's the TV on the wall, etc. Now, prior to the Tax Cuts and Jobs Act of 2017, there was this requirement that you had to have first use of the asset, which for most lay people, that means brand new. They changed that under the Tax Cuts and Jobs Act and actually created a requirement that if it wasn't meeting the first use test, but you had never had depreciable interest in the asset, so in other words, you had never owned it, you can then take bonus depreciation on it as well, which means if you go out and you buy this desk, it doesn't matter anymore if this desk is new. You can now take bonus depreciation on it. Now, there's other extensions to bonus depreciation that we got under the Tax Cuts and Jobs Act. One of them is qualified improvement property, which, although wasn't a new concept under the Tax Cuts and Jobs Act, it did change. So the way qualified improvement property works is if you own a building and you put in improvements to the building, anything that's non-structural, that's to the interior of the building, and by structural, they really mean structural in this point. It's the things holding the building up. Those assets are now eligible for bonus depreciation as well. So it really starts expanding when you get beyond it. And then there's some weird areas. You asked if you buy a building, can you take bonus depreciation on it? Typically, no, but there are a couple exceptions to that rule, the one being gas stations and the other one being car washes. Certain assets that meet what's called petroleum marketing. So if you're using them to sell gasoline or other things, you can potentially get bonus depreciation on those as well. But that's a very case-by-case specific situation that we would probably want to talk to somebody about.
Yeah. So as we talked earlier about bonus depreciation being a great strategy for improving the activity in real estate, the main reason is impact on immediate cash flow.
Mm-hmm.
You walk through the math on that versus your normal accelerated depreciation found under makers.
Well, so if you look at standard depreciation, I go out and I buy a building. Standard depreciation on a building is over 39 years. Now, we all know we can do a cost segregation study on the building. So let's say I buy a building for $3.9 million. And this is like the old physics problems when you were in high school. You got to ignore the effects of air resistance. We're going to ignore the effects of land because we don't want to go through that in the math. So if I buy a building for $3.9 million, I can take that depreciation over 39 years. So every year I get 1/39th of it, or $100,000 worth of depreciation. Now, if I go out and I do a cost segregation study on it, and I find that that's not really a $3.9 million building. It's a $3 million building with $450,000 worth of 5-year assets and $450,000 worth of 15-year assets. Now, without bonus depreciation, those 5-year assets are on what's called a double declining balance. So I get 20% the first year, 32% the second year, 16% or so the third year. So I'm getting most of that depreciation up front, but it takes some time. The 15-year assets are on 150%. So once again, it's front-loaded, but it's still not as good. With bonus depreciation, in my example, that $3.9 million building that I move $900,000 to shorter lives, that $900,000 gets written off right away. And the nice thing is that's true whether it's a new construction or a purchase building. So that $900,000, let's say I'm at a 30% tax rate. I just saved myself that first year. I saved myself $270,000 on my federal income tax that then I can use to reinvest in the business. I can do other things with it.
So as you look at the tax legislation and some of the recent proposals that are out there, where does that sit? What are the recommendations? Do you see that the increase to bonus depreciation has an effect on some of the budgetary type conversations that they're going into, and will that cause a pause in getting this increased?
Well, there's two aspects of that. There's what does it affect on the federal level? I don't think on the federal level it has that much of a budgetary effect. And we've talked about this. You and I have had these conversations before where bonus depreciation is one of those easy things for the government to pass because it doesn't have a huge effect. Typically, they're looking at 5 and 10-year budgetary windows. And because it's a timing difference, it doesn't have a huge effect on that 5 and 10-year budgetary window for the government. It does have a big effect on businesses. So that then raises the question, what does a business do today where this is in limbo? They might pass this bill, they might not. And the key thing there is you want to still work on maximizing your depreciation deductions. So in my example of a $3.9 million building, well, I can still do the cost segregation study on it. My $900,000 I move out of that, whether bonus depreciation is at 80% or 60% or 40% or even at zero, I'm still getting a benefit to doing that. Now, if they pass the legislation, it's going to be a bigger benefit, but the benefit doesn't go away just because we don't have 100% bonus depreciation. It just makes it more beneficial, especially when for certain types of property. Say a warehouse, where you might have a much larger portion of that number slanted towards the 15-year property, that's a bigger window. I will say, there are types of assets that might be more interested in looking at, say, a cost segregation study if this doesn't pass. And the example of that would be qualified improvement property. So take, for example, a business owner that is going through a renovation on a building they own. And most of that is all interior, non-structural things. So they're eligible for bonus depreciation. Well, if bonus depreciation goes away, they're going to want to get as much of that as possible into that 5-year bucket because they can still write off 50% of it in the first 2 years, almost 70% in the first 3 years, versus the 15 or the 39-year buckets. So There it's going to make sense to do a cost segregation study as bonus goes away. However, if bonus sticks around, then you might not even need the cost segregation study because you're able to write off most of it through bonus anyways.
Much a lot. Back to the example you said earlier, car washes, gas stations, follow that same example you just laid out there.
Exactly. We have seen in the past car washes and gas stations, they have a lot of equipment in them. Now, if I go out and I buy a car wash and I can write the entire thing off under bonus depreciation, I really don't care about separating out the equipment from the building because there's not enough arbitrage there. But as I start switching to a environment where maybe I don't have bonus depreciation, then the difference between the 5-year and the 15-year makes a huge difference.
So we just talked bonus depreciation. How does that differ from 179?
That's actually a very good question because people don't think about it enough. The way I think about 179, it's almost like a sniper versus a bonus depreciation would be more of a shotgun. Where bonus depreciation hits everything, 179 you can use to pinpoint different things. So let's take a step back and talk about what 179 is. So 179 is an immediate ability to immediately expense certain assets. Now, it covers very similar types of things to bonus depreciation, but it's an immediate expensing of certain types of assets. Bonus depreciation, on the other hand, is an acceleration of depreciation deductions. So first, when I'm trying to determine between 179 and bonus, the first step is to understand the order that they go in. It's kind of like remembering when we see it all the time on Facebook is 6 times 3 plus 4, and everybody's trying to figure out who gets the math right.
Yeah.
You have to understand the order of operations. So when we're talking about depreciation law, 179 comes before bonus. Now, TCJA changed a lot of things with 179. They increased the amount. They also added certain things. Now, roof replacements are 179 eligible. HVAC systems are 179 eligible in the terms of replacements. But what's important with 179 versus bonus is 179 has limitations. Number one, if you spend too much money, you're not eligible for 179 anymore. Certain investment assets aren't eligible for 179. The other thing with 179 is 179 can only be used to bring yourself down to zero income. So you can't push yourself into a loss. However, on the flip side, 179 is much more beneficial because I don't have to take all of it if I don't want to. So the way bonus depreciation works is, let's say I go out and I spend $500,000 on 5-year property over the year and $500,000 on 15-year property over the year. I have to either elect taking bonus depreciation on all my 5-year property and elect in or out of bonus depreciation on all my 15-year property. So I can't go and pick and choose. If I buy a computer and a desk, I'm either taking both of those for bonus depreciation or I'm taking neither of them. Whereas 179, I can pick and choose. So if I'm sitting there and I'm trying to manage my taxable income, let's say I made $300,000 and I want to get myself down to $100,000. I don't want to take myself to zero because I want to save some of those deductions for when they're used against a higher tax rate. I can use 179 to pick and choose specific assets. So it's much more like a sniper approach. Whereas on the flip side, if I'm sitting there and I want to maximize all my deductions, I want to push myself into a loss, carry forward that loss into future years, then bonus depreciation is a much better avenue for me to do that. And that's on the federal side. Now, the state side, a little bit different because not all states recognize bonus depreciation. Most states do recognize 179. So if I'm sitting there in a high income state, or high income tax state, I should say, and I'm looking to minimize my tax in a specific state, if they recognize 179 and they don't recognize bonus, I might first take my time to make sure I'm maximizing 179. Now, there's a few other areas we can utilize this. One of the examples of this is 179 can be used against things that bonus depreciation can't. So, for example, let's say I've got an HVAC system and I have to replace it. So I have a manufacturing company and I'm replacing my HVAC system. Typically, that's not going to be eligible for bonus depreciation. But in certain cases, it is eligible for 179 if I have the opportunity. So by understanding that interplay, I can potentially maximize my deductions by going, wait a second, I don't want to use this over here. I want to use 179 over here, and I want to use bonus over here.
Yeah, great point on the interaction. The other one that was coming to mind, not necessarily the 179 piece, but as you talked about qualified improvement property. The one type of property we've seen a lot in terms of development are the mixed-use facilities, part residential, part retail. I think about all the clients that maybe are right on that line of, okay, am I meeting the 80% income test derived from residential versus commercial? And they start to freak out about it.
Yep.
And it's actually, if you can stay within the realm and keep the property identified as commercial, where it's 39-year property, that pays benefit to you down the road as you're doing those qualified improvement and renovations.
Yeah, and that's something we didn't mention earlier when I mentioned that qualified improvement property, is that residential property does not qualify for that qualified improvement property. It's only commercial buildings. Now, as you mentioned there, the way the IRS defines that, if 80% or more of your income is coming from non-transient housing, then you're considered residential. You get a shorter life on the building. It's a 27.5-year life, but you don't get QIP. So right now, obviously, we're sitting here in downtown Indianapolis. Well, a lot of cities are seeing lower occupancies in these old office buildings, like what we're sitting in. And so there's been a big push to convert some of them to residential. Well, if you manage that and you keep your income more than 20% from the commercial aspects of it, then the entire thing is considered a commercial building. Then, you, as you mentioned, you can go out and get qualified improvement property on that conversion to residential, even though those are going to be leased as residential because the building as a whole is considered commercial. Same thing holds true on certain other types of assets. We see this on short-term rentals. If you're going out and you're buying a beach rental property and you're going to rent it out to someone, potentially that might be eligible for QIP if you go and renovate it because it's considered short-term rental, which is a 39-year asset, versus being a long-term residential property, which is a 27.5-year asset.
So Dave, as we look at bonus depreciation, what are some of the things that our listeners should be aware of from a misconception or additional tax planning strategies?
Well, the first thing that we see is this qualified improvement property. Sounds great. And I mentioned, maybe you don't need a cost segregation study because you're just doing a renovation. But keep in mind, if you own your own building and you're renovating it, it's probably not all bonus eligible. So right now, let's say just arbitrarily take a manufacturing building, and they're going through a renovation, and they're renovating the interior, they're putting new equipment in, but at the same time, they have to fix the exterior of the building. They have to put a new roof on it. They have to put new HVAC on it. Those things are not bonus eligible, and it's important that they carve those out and they do a cost segregation study or something else to maximize what is bonus eligible, but also to pull out the things that aren't. And a lot of times people have that misconception that I'm just going to stick everything in this QIP bucket and I'm fine, but that really, in reality, that's not the specifics of it. You have to actually look at what qualifies.
Another area that I was thinking of, I just got off a call a few days ago with a client down in Tennessee, large warehouse. It went through a renovation, changed all the light fixtures out. They called me up and they said, "Hey, Justin, we need to do a 179D study. Let's take advantage of the energy efficiency deduction here." And it's like, well, wait a minute. A lot of this lighting qualifies for that qualified improvement property, and due to the bonus depreciation rates being so advantageous, let's talk about that piece. Let's save the 179D study and put more of this into the qualified improvement property.
Well, and that brings up a good point. It's important whenever anything is tax related that people are looking at it holistically. It could be a situation where you're correct. They don't need to pay for a 179D study because they can go and get bonus depreciation a lot easier. We see it on areas like that. We see it on areas like solar system installations. Bonus depreciation is so high that what's happening is business owners are getting sold on these solar installations because of the tax credits and depreciation associated with it. Well, do they actually have the ability to absorb it? So let's say you're sold on a lighting retrofit, and part of why you're sold on this lighting retrofit is it's going to cost you $300,000, and you're going to write that off. So this lighting installer comes to you and says, you're at a 40% tax rate, you're going to write $300,000 off. That's going to take $120,000 out of the basis of these lights you're replacing. The problem is, if you don't have the taxable income to absorb it, that cash flow modeling that the installer gave you is out of whack with what actually you're going to see on your tax return. So that's why it's important when you're talking about any of these things to look at how it models out, but then talk to the CPA, talk to the tax preparer to make sure that it actually makes sense for your books and records.
So as we're sitting here, tax season, see our listeners, our CPAs are in front of clients right now. What are 2 or 3 questions that they should be asking their clients in terms of this recognition of qualifying for bonus depreciation or not?
Well, the first thing that CPAs really probably should be looking at is just what did you do over the years? And that's a standard question. But also, what are you planning on doing next year? Because some of this is a planning tool. Is if you're sitting there, let's say take today. Bonus depreciation is a timing thing. And depreciation in general is. So sometimes people go, well, if I don't maximize it this year, I'll maximize it next year. The problem is you don't know economically how a business is going to do year over year. So maybe this year is a very high tax year, and next year maybe you see a decline in gross receipts or something else, and you can't utilize it. It's critical that when you can use depreciation, you maximize it so that it offsets that income, creates that cash into your business, and don't hold on to it. We too often see business owners this time of year going, well, you know what? I'm going to hold on to that depreciation deduction until next year. Number one, you let the government hold your money for an extra year. But number two, you don't know what your income's going to look like. A lot of times, and you know this as well as I do, is that business owners often see depreciation as just a timing difference. Now, when you're young, you go through financial planning seminars or anything else, everybody always tells you, hey, don't overstate how much for your company to pull out of your income. You don't want the IRS holding on to your income all year long. So if you're getting at the end of the year, you file your tax return and you get a $5,000 refund, that might feel good. But if you talk to a financial planner, they're going to go, wait a second, you just gave the IRS an interest-free loan. Whenever we're talking about depreciation, we're talking about the same thing, but over much longer periods of time. By not maximizing depreciation, the IRS might be holding on to a business's money for 5, 10, 15, 20, even 40 years.
You know, one other misconception I was thinking of, and I just had a call within the last week on this. You know, as we look at bonus depreciation, you know, with cost seg, you know, we can retroactively perform a study, put the results on a 3115, catch up the missed depreciation. A lot of taxpayers think, you know what, if I don't do it this year, when there's 100% bonus and I'm going to miss out on that. Well, it's important to note that bonus depreciation is tied when the asset is placed in service, not when a cost seg study is performed. That's kind of one piece. The second question I have for you is going back to the legislation right now. What's your advice to clients that are sitting here debating, do I extend the return to wait for 100% bonus, or do I go ahead and complete the return?
So I can't answer whether somebody should extend their return or not. Really, that comes down to an individual taxpayer. Now, what I can tell them, if some legislation passes and retroactively changes the rules, there will be ways to fix it. So for most taxpayers, you just want to move forward with the legislation as it is today. And then if it changes, most likely you'll either be able to supersede your return, amend your return, file a 3115 next year. There's going to be multiple ways you can fix that. But that's an individual decision as to whether or not I want to extend. For most people, even if they don't extend, they should probably be paying their tax bill as if it doesn't change. Because what we don't want to see is somebody go, you know what, I'm expecting this legislation to pass. I'm going to limit actually what I pay the IRS on my bill when it comes due because I'm thinking that I'm going to get this big jump in May or August when this bill passes. I would not sit back and wait for that.
So Dave, busy year ahead for us. You got election year, you got interest rates that are proposed to lower over the course of the year. What's the outlook for 2024? What are the things that you're excited about? What do you see on the horizon for real estate in specific?
Well, I do think real estate, it's almost like a spring that's been kind of pulled back and it's really tight right now. And they're just waiting for that excuse to jump. Everybody's sitting there going, interest rates have been up. And especially on the commercial side, prices have dropped some. And so everybody's sitting up, there's this pent up demand and it's just waiting to explode. So when interest rates start dropping, I think you're going to see a quick increase in that demand where people are going to start, because low inventory causes people to hold back because they can't sell their one property to move into another one. There's a lot of limitations that occur then. So once we start seeing that, we're already starting to see it on the residential market. We haven't really seen it flow through to the commercial market yet. So I think that's going to change things. But the other thing for business owners to consider is with increased interest rates, makes the demand to maximize timing differences, like cost segregation, even bigger. So if I'm sitting there as a business owner and I've got a variable interest loan and I'm sitting on depreciation deductions that I can pull forward, I want to pull those forward actually probably more now than ever before because I can use those to pay down my loan when my interest rate's high. When I was sitting there a few years ago at almost negligible interest rates when they were next to zero, it didn't really matter if I maximized my deductions because I was getting free money from the bank. Now that it costs more, it's going to be more critical than ever to pull those things out.
Perfect. Well, Dave, thanks for your time today. Listeners, thank you guys for joining us. Please remember to subscribe to our channel, Let's Talk Tax Podcast. We also have all of our social media outlets, LinkedIn, Facebook, Twitter, or X. Also visit our website, McGuireSponsel.com. There's a lot of great resources. We'll have updates to any tax legislation as it rolls through the year, so make sure you follow that. Thank you.
Thank you.